Welcome to the Federal's Big Money. In these challenging times, when the global and domestic markets are going through turmoil, how should one invest? In today's Big Money, we will discuss or focus on startups and their IPOs. We'll try to find answers to questions such as what is the best thing to do before buying stocks of a startup, and more importantly, what one should do after buying those stocks. I am Giri Prakash. Before we go further, let me request that you subscribe to the Federal's YouTube channel. The year 2021 was a nightmare for most of us, as all of us went through a near hellish second year of the pandemic. Most sectors of the economy were down, and the governments were struggling to balance their budgets. The investment was the last that was on most investors' minds, and they were focused on securing their health and that of their loved ones. But one sector that stood out were the startups. Many budding entrepreneurs who thought of converting the crisis into an opportunity began to float new ideas, resulting in an unprecedented boom. During the year, many Indian startups started to look at the stock market as a way to raise money. Many unicorns and startups in their later stages went public or made plans to do so. Now, a year later, in 2022, things look slightly different. With the shares of startups like Nykaa's taking a nosedive, it is time to take a pause. What kind of due diligence must one do, either before buying these stocks, and when the stocks of a particular startups are going down, whether one should wait and watch or sell them off in a hurry? We will discuss that in detail. But before that, let me give a brief background. A total of 11 Indian startups have gone public since the beginning of 2021. Paytm, Nykaa, Cartrade, MapMyIndia, EaseMyTrip, Delivery, Fino Payments Bank, India Mart, Nazara Technologies, Policy Bazaar, and Zomato are some of these companies. But with a few exceptions, most of these tech startups shares have been under pressure, and most of them are now trading at much lower prices than when they first went public. Let us measure the scale of the meltdown. FIOS, India's most high technology initial public offerings over the last 16 months, have floundered since listing. They have shed more than $18 billion in value. These includes Zomato, Paytm, Nykaa, Delivery, and Policy Bazaar. Such a huge loss has obviously made investors less sure about IPOs for startups. And surveys show that nearly 2/3 of investors don't want to invest in IPOs for startups. The plans of dozens of startups that want to go public have stayed the same, like Flipkart, PhonePe, Byju's, Swiggy, and Oyo. The total valuation of all these startups put together is around $110 billion. 8 startups have already filed their draft red herring prospectus or gotten SEBI's approval for their initial public offerings. So what should people who want to invest in startup IPOs watch out for? And what should they watch out for after they buy shares in startup IPOs? The recent crash of Nykaa shares, an online marketplace for leisure and lifestyle products that went public a year ago, may indicate that investors have lost faith in the company. But the slide is more because of the exit of anchor investors. Days before the expiry date of November 10 for pre-IPO, there have been other investors too who have been selling their shares of Nykaa, and this has actually picked up pace over the last 1 week. Now, what do we need to do for that? How do we look at these kind of shares? In the case of Nykaa, anchor investors are institutions that are allotted shares at a fixed price before the IPO opens to the public, offloaded their shares at a higher value. which is the usual practice and should not be a cause for worry. Because of the offloading of shares, Nykaa shares have dropped by 17, 25, or 46% in the last 3, 6, or 12 months, just like Zomato's did after it bought Blinkit, whose shares also dropped before the IPO lock-in period ended. But Nykaa and Zomato aren't the only companies whose stocks have gone down. Almost all internet companies have dropped, their shares have dropped by 25% to 50% since their peaks. Nykaa may be in a better position than most of the startups that have gone public. Even though the stock's value have decreased, the business is still making money. Nyka's performance in quarter 2 of the financial year 22-23 was reasonable and in line with its gross merchandise value growth of around 45% year on year. Most of the performance measures were good. In their report on Nykaa, Himanshu Shah and his team at Dolat Capital said, "We expect Nykaa to trade at a premium due to its strong business position, superior execution, focus on profitability, consistent growth in addressable market size through new brands, distribution expansion, and its evolution as a house of brands." The Indian beauty and personal care market, which is also called BPC, is worth about $17 billion and is expected to reach $20 billion by 2025. Because of its content and influencer-driven strategy, Nykaa has a significant share of the online BPC market. This is because BPC is a high-margin game. Because of this, investors may want to keep their money for longer. Are all startups which have floated IPOs as good as Nykaa? For example, Zomato needs to be looked at more closely. Paytm, Delivery Policy Bazaar, and Zomato are still trying to figure out how to make money, even though they're among the 11 startups that have gone public since last year. So the bottom line is that people who want to invest in startup IPOs should examine what kind of industry they are part of and whether there is a path to profitability for each of them. Those who have already put money into an IPO should use the same criteria before getting out, which means focus on the fundamentals always. Big investors like venture capitalists play the valuation game to get in and out of startups. Still, for regular shareholders, the fundamentals should tell them which way the wind is blowing. The mantra for small investor is this: always go by the fundamentals. Read enough, understand enough, talk to people, and finally understand that fundamentals are the ones that will determine over a longer period of time whether you should hold on to the stocks or drop out of the company. So here is where we wrap up the Federal's Big Money feature. Please tune in for more of them soon. I'm Giri Prakash, signing off now. Thank you.
Subscribe to the Federal's YouTube page for more news and updates.